The global financial landscape experienced a significant seismic shift as the yield on Japan's 40-year government bonds surged past the 4% threshold. This dramatic movement serves as a blunt declaration that the era of nearly free capital, which has defined the Japanese economy since the mid-90s, is rapidly approaching a conclusion. For over 2 decades, the Bank of Japan acted as a monumental backstop, utilizing an expansive monetary printing press to artificially suppress interest rates near zero. However, the market has now signaled a definitive rejection of this old order, demanding a higher price for lending to the state. The immediate catalyst for this volatility is rooted in the current political climate. Following the announcement of an upcoming general election, a radical fiscal proposal emerged: the total elimination of the food consumption tax, reducing it from 8% to 0. While such a promise appeals to voters facing rising grocery bills, international investors reacted with immediate concern. The fundamental question remains how the government intends to fill the resulting massive revenue void. Without corresponding spending cuts, the only alternative is to issue a staggering volume of new debt. This anticipated flood of bonds has caused prices to plummet and yields to skyrocket, reflecting the increased cost of government borrowing. The implications of this shift extend far beyond the borders of Japan. As the world's largest creditor, Japanese institutional investors, including massive pension funds and insurance companies, have historically funneled trillions of dollars into overseas markets like United States treasuries and European equities in search of better returns. With domestic yields now reaching 4%, the incentive to keep capital at home has strengthened. If a massive repatriation of funds occurs, global markets may lose one of their most consistent sources of liquidity, leading to downward pressure on asset prices worldwide. Ultimately, the burden of these rising rates will fall upon the Japanese citizenry. Higher bond yields translate directly into increased debt servicing costs for the government, which must eventually be paid for through higher income taxes or reduced public services and welfare benefits. Furthermore, as government rates climb, they pull the rest of the economy upward, making mortgages and business loans more expensive. This situation highlights a classic economic reality. The free lunch promised by short-term political slogans often carries a heavy, long-term price tag that the next generation will be forced to settle.